Okay, so this is our third session on Chapter 17. We've covered the book slides, so we've covered the primary material in that chapter. What we're going to now do is, today we're going to primarily focus on financial ratios. I didn't include any operational ratios, but those are fair game. They are fair game, and you'll see them on the final. Okay, so what I wanted to do with today's class is kind of maybe do a little hands-on work with the ratios and discuss some of them. So first I want to show you a real financial statement, which is Catholic Medical Center. So I'm going to show you that. So let me just move this here. So we've talked about financial statements. So this is a audited, consolidated financial statement for Catholic Medical Center. Right, and we talked about this way back in Chapter 3. Like, what does that mean? Well, Baker Newman Noyes, which is an accounting firm that does do some consulting work. We have some HMP alumni that work there that I think your group can meet them. But good organization. They do most of they do a lot of the financial statements, financial auditing of financial statements for hospitals in New Hampshire. So this is Catholic Medical Center, which is CMC. It's out of Manchester, and this is their audited financial statements. We're going to scroll down. So you start with an auditor's report that says basically this is an accurate statement of how Catholic Medical Center is doing. The auditor's report doesn't say you're doing well or you're doing poorly. What it says is these numbers are accurate, right? So you can have an accurate accounting of an organization that's failing. Right? And Catholic's not failing, obviously, and you can see the dates here. This is 2015 and 16. So these are fairly historical. Catholic's doing okay, my understanding. But like all hospitals, it's a tough market to be in. So these are the actual financial statements. So you have the balance sheet. So it starts with assets and then shows you liabilities and net assets, right? So they talk net assets instead of owner's equity because they're a not-for-profit. And then these are the three categories of net assets, right? You have unrestricted, which is basically retained earnings. Temporarily restricted and permanently restricted are both donations of, temporarily means they've been given with some sort of strings attached and the organization hasn't been able to trigger the release of those. And it might be a time frame, like you have to hold this money for 10 years, and then after that you can spend it. Or it might be, I'm giving you this $1 million so that you can build a wing of a new ward and name it after my grandmother, right? Either one of those things. So you can't spend the money. It's temporarily restricted until you meet the conditions that I've given you, whatever that might be. And then permanently restricted is money that's given to the organization to form kind of a called corpus. And typically the organization can't spend the principal, but it can spend the interest earned. So it's a gift meant to kind of be a gift that keeps on giving, but the organization is not allowed to dip into the principal. So that's what's one of the things that's different about this financial statement is because it's a not-for-profit, it calls its equity accounts net assets. Okay, so that's the balance sheet. And then we have below that the consolidated statement of operations or statements of operations, which is the non-for-profit speak for income statement, right? So this is the income statement for 16 and 17. And so you can see it starts with net patient service revenues, right? So it basically skips the gross number, right? Which we've talked about a bunch of times. Being the gross is the the charge master amount that was billed out. And so they're basically just going straight to net patient service revenues, net of contractual allowances, and then they go into provision for doubtful accounts. We'll talk about this more in detail in a minute. I just want to show it to you in its form in the actual statements. I've transferred all of this data into an Excel spreadsheet, which I sent to you last night. So we'll be looking at the spreadsheet in a minute, but just want to show you what it looks like for real. And then changes in net assets is the statement of changes in owner's equity. Remember, net assets, owner's equity, same thing. We don't care all that much about that statement. Consolidated statement of cash flows is a big deal. So you have the 3 sections of the cash flows, and we're not going to talk about this statement today. But remember, just a reminder, there are 3 sections to the cash flow statement. There's the cash from operating activities, right? So you have, and that ends with net cash provided by operating activities, and there's all these changes that affect it. And then the second section is investing activities. So that's by investing, they mean buying and selling property, plant, and equipment in particular, but changes in the way they're holding their cash. And then financing activities, which is how they're dealing with their debt. Right? And if this was a not-for-profit, you could also have sale of new stock. Excuse me, if this was a for-profit, you could have changes in equity here too, in the sense of buying and selling, buying back stock or selling stock, selling new stock. So those are the 3 sections of the cash flows. Let me see if I can find it real quick. So then there's so you can see, I don't know if you can see in my, this is 49 pages long, right? The core of it is those 3 or 4 pages we just looked at. And then there's like 40 pages of notes that explain all the entries in more depth. Let me just see if I can find real quick. These are all policy statements about what they did and how they made their decisions. I'm looking for, so we can talk about like malpractice, like they're accounting for malpractice. And you have this, I sent this to you, so if you're like really excited about looking at it, you can. There we are. This is what I was looking for, net patient service revenue. So net patient service revenue, let's see. What I told you was on the statement, they're ignoring the gross patient service revenue, but you can see their gross in 2016, what they billed out based on, oh, hi, Kitty, what they billed out based on the charge master was $1 billion, right? And then they had contractual allowances of $681,000. And then provision for doubtful accounts brings them down to their net patient service revenue of $355. So they could conceivably say we're $1 billion organization, right? But that would kind of be a lie, and that's why they don't do that anymore, right? So it used to be your typical income statement started with gross, stated gross, and then it had these lines, and it would get down to NPSR. Now basically we just lop off that gross, we don't talk about the contractual allowances, and we just go straight to the net patient service revenue. So I thought that was something you could see, and so you can see a lot of this kind of detail in the notes. And so if you're a little more advanced, and as you go forward, and if you do this, for a master's program, if you take finance in a master's program, you might spend some time actually drilling into the notes. We just don't have time to do that here, other than I just want to show you that as an example. Okay, so I'm going to stop my share and restart my share now. Okay, and so what I want to do now is transition over to looking at, like I said, I moved all of the, or copied all of the relevant information over to the Excel sheet that I sent to you guys last night. So let's see if we can pull this up a little more. So this is the balance sheet. So we've got a sheet for the balance sheet, a sheet for the income statement, and then common ratios. So that's what we're going to work on today, is looking first at, I'm going to show you how to do some kind of quick comparison work. And these are techniques that are, we really use in the field and are useful for, as an analyst, whether it's, whether you're working on financials or whether you're working on any other kind of data, it's useful to think about them in some of these terms. So I'm going to, oh, it fixed itself. If you wind up with these hashes, right, if you get all these hashtags, all that means is there's nothing wrong with your data. It just means that your column is too narrow. So you just need to stretch out the column a little bit. So we have these assets. So we can kind of scan down here. So we have the asset side of assets and liabilities, starting with the assets, right, of Catholic Medical Center. And so remember, we have total current assets is kind of, so we have this first section is current assets. We have kind of bottom line current asset, total current assets. And what are the big things we're looking for? Cash. We care a lot about cash. So we want to have some, plenty of cash on hand. Short-term investments are cash-like. They're easy to get to. If they need the cash, they could probably get it like overnight. Accounts receivable, this is a big deal. This is our accrual process, right? So we're billing out for visits and for surgeries and all that stuff, and we're getting paid. And here's one thing, like that's a big jump from 38 million to 47 million. Is that good or bad? Is it good to have accounts receivable go up from 38 to 47?
No,
what do you think?
Now you're waiting on even more accounts for payment.
Yeah, so really what this line tells you is you're waiting on more accounts, right, for payment, which is, Emma's exactly right. So is that good or bad? Well, it kind of depends. So it's a little bit of a trick question. Any one of these lines by itself, most of them don't really tell you a story, right? And that's kind of the point of ratio analysis. And we talked about this over the last two classes, that any one ratio by itself tells you part of the story, right? Or any data point here tells you part of the story, but it doesn't tell you the whole story. And so you don't drive your car just looking at the speedometer. You need to pay attention to the gas gauge and everything else too, right? So it is important to look at each thing individually, but it's important to kind of see it in its context. So that ought to stand out to you. If you're a financial analyst, a jump of almost $10 million in accounts receivable, which is like a 25% increase year over year, is pretty significant. So what are we going to want to look for to see if that's okay to have or not? What would you think you want to know?
The volume, if it's increased.
If the volume, so volume of like visits?
Yeah, so if your volume increased exponentially, then that jump in accounts receivable isn't as severe. But if your volumes remain about the same, then you're just getting paid less, or you're not collecting as much.
Well, you're collecting more slowly, right? That's kind of, so that's exactly the right interpretation. So that's the kind of insight that you're going to want to have with this kind of data is, so what Emma was saying was, it'd be fine to have a 25% increase in accounts receivable if you had a correspondingly large increase in revenues over that same period of time. Otherwise, it just means you're collecting your receivables more slowly than you had in the past, which isn't good, right? So it's kind of looking at that change kind of just tells you, well, it depends, right? It just depends. If we go down here to, the current line, the total line, we've gone from 107 million to 123 million. Good or bad? Well, all other things equal, it's better to have more current assets. But our point earlier was 10 million of that is an increase in accounts receivable, which may or may not be a good thing, right? So that's kind of important. Property, plant, and equipment net. Here they're reporting, and if we dug into the notes, we would see what their gross PPE line would be, and then we would see what their accumulated depreciation was, and it'd give us some more information. They have some other assets that we haven't really talked about in class. In this case, they have a note receivable, which means that they've actually loaned money to somebody else. The organization has actually loaned money to some other entity. And so now they have a note that's due to them. So that becomes an asset. They have some intangible assets, which means some sort of intellectual property that they own. And then they have assets whose use is limited. So this is a little more into the weeds than we've done with our kind of toy examples in class. But they have a pretty big pension obligation. So they have pension and insurance obligations. Those are pretty stable, but they've got $14 million. So what does that mean? Well, they've got probably some of their senior officers. They have to pay pensions to. So they're not just getting 401ks, but they're getting, like, when you retire, you're going to get this money. So this is money that's been set aside to pay those obligations, and even though you have it, you can't touch it. So it's cash sitting in a bank that you can't touch because it's limited, right? And then this section is money that has been designated either by the board for some purpose, like, hey, we need to set aside money to build a new building. So management, you can't touch that. Or we talked a minute ago about donor restricted investments. So that's money that donors have said, here's the money, but you can't touch it yet. So that would be your permanently and temporarily restricted. And then here you have money that's set aside for them to pay their bonds. So that's, more money, bond obligations. So that's money that they really have, but they've set it aside because that's part of their contract with the bondholders, that they'll set this money aside and hold it. So we total that up, and we can see total assets have increased from 309 to 323 over the last over from 15 to 16. So 4 years ago, five years ago to 4 years ago, right? And a lot of that increase really comes from up here in the change in current assets, and we'll see that in a minute. And then we go down here to the liabilities and net assets. And remember, we're saying net assets as opposed to owner's equity because this is a not-for-profit. And so we have our current liabilities, right? So this is the current portion of their obligations, meaning stuff that they're expecting to have to pay back within a year. And so we can look to see, well, where's the changes here? Well, there's not much. If you look at the current, the total, there's not much of a current of a total. It's only about 700,000. So we're not going to get too excited, but we are looking for, are there any big changes here? And mostly not. So not too much to worry about here. How about here? Accrued pensions and other liabilities less current portion. That's a big number. That's a big change, right? And so this is, again, that accrued, not accrued. Right, so there's a little typo. That's a big jump. So this is where you'd want to dig into the notes in the financial statement to figure out what happened, because that is a non-trivial amount of a change. And to be honest with you, I have not dug into the notes to figure it out. not so relevant for today's class. I probably should look at them in the future. I just didn't have time when I was doing this last night. And then they have their long-term debt, which would be probably their mostly bonds, but they may also have mortgages. So these are multi-year debt obligations. And so then you total up your liabilities. And there was a significant increase in liabilities, mostly coming out of this change in pensions and other liabilities.
I have a question about the notes.
Yeah.
So the auditor's writing that whole document and writing their notes, but is that all public? Obviously the stats and the data for the numbers is public information, but the notes on it?
So technically, because they're a not-for-profit, you can request their financial statements. As an investor, I actually just pulled this off the internet. So some of these are floating around because of when they go for financing, when they go for public financing of things, they have to release their financial statements. So kind of
when they go to refinance or go to get more money from government.
Well, typically private, right? So if they want to issue new bonds, they have to release their financial statements so that investors can evaluate whether they want to lend money to the organization or not. So now they do. The IRS forces them to do a 990, a Form 990 each year, an IRS Form 990, which is like a tax return for a not-for-profit, and those are public, and you can look them up for any not-for-profit entity.
Also, like we discussed in management that like once these get released, and it's kind of once you release that it's that your company organization is going bankrupt, that you have to obviously let your employees know within a certain amount of time. So the only time you actually have to do that is if you are declaring bankruptcy. So like if you were to release this public information and it showed that you were in horrible standing and you're about to go down, you technically don't have to tell any of your employees until you officially file.
That's an interesting question. Jameson would be better to answer that technicality. She knows a lot more about bankruptcy stuff than I do.
You could openly just release this and be like, yeah, we're doing horrible. Good luck.
Yeah, well, the 990 will tell you that, right? So every year they have to produce that 990. So that's going to be pretty well known. This information, technically, these statements can be accessed, but organizations tend not to let them out too willingly. The audited versions, the 990s are out there, and you would be able to evaluate reasonably well because they can't lie on the 990. It's a government form. They can't lie on it legally, right? They can dress it up a little more because it's not audited the way that these are. So they can dress it up a little bit, but it still has to be accurate because it is a government form. So you would have an idea that the organization is not doing well, right? That's not going to be a secret. So anyway, so we go down here, we see we already talked a little bit about the net assets. So this is your total liabilities and net assets. So that's the balance sheet, right? So we talked about that. And the reminder is these have to be equal, right? The total liabilities and net assets has to equal the total assets because the liabilities and net assets section is just really saying what is the financing of the organization, right? So the organization has all this stuff. The second section, the liabilities and net assets, really just tells you how is it financed, right? How much of it is financed by debt and how much of it is financed by equity. And that's really kind of in a nutshell what that statement says. Okay, so we've done that, and you guys know that already. So today I want to do a couple of techniques. The first is to calculate the percent change from year over year. And it would be nice if I had a third year's worth of data. I just didn't have it. I may be able to dig it out somewhere at some point, but I didn't have a chance to work on it yesterday. So the percent change is pretty simple. It's a pretty simple formula. And the way I remember it is you take new minus old divided by old, right? So in this case, 2016 is new. minus 2015 is old, divided by old. So what I'm doing is typing in a formula in Excel. So this you want to learn how to do this. If you're not comfortable with it already, you want to practice doing this. So see if you can't follow along with me while I do it. So in this case, it's just equals parentheses C4 minus D4 divided by D4. And that tells me I've got an 8%, roughly 8% increase in cash. And so I could leave this in a decimal, or I could change it to a percentage. The way I change it to a percentage is I select the cell so that it's highlighted, and then I go up here to the percentage and I just click percent, and boom, you've got the percent. I'd like to see at least one decimal, so I'm going to tell it, give me an increase of decimals. So I'm going to tell it to do this left arrow, and I'm just going to give it one decimal. So I've got 8.0%. Okay. And now that I've done that, I'm going to use that same formula all the way down. So there's nothing fancy about this. So I'm going to copy that down, drag that down by grabbing that corner. There's a little square you can see in that bottom corner. If I put normally that's the cursor's like a cross. When I put it like a fat cross, when I put it on top of that corner, it switches to a very narrow cross. I can left click and hold and drag, and that'll populate all the percentages going down. So then I'm gonna copy that formula and put it in the rest of the way down.
Can you show again how you got it to 8.0?
Yeah, sure. So when I initially do it, it's just 8, right? And I go up here to number, and there are on my in my version here, assuming if you're in the Windows version of Excel, this is what it should look like. And so you'll have a left arrow with zeros, and then you have a right arrow with zeros. So if you just select the left arrow with zeros, and you can see my little message says increase decimal, then you just click once. If you click twice, you get an extra 0, and then you can take away that 0 by clicking decrease decimal.
Oh, okay.
Right. And this is a judgment, right? Because it's like how how far down into the, how many decimals do you really need to see? And for me, this circumstance, one decimal is probably more than enough, right? No decimals is probably fine, but I feel like it gives me a little more, particularly when we got small numbers like 1.2 or 0.9. It's useful to see them. And then I'm just copying the formula down. And my goal is to have all the way down. So now I have the percent change year over year. So before we were kind of eyeballing changes, and saying, well, that looks big, and that's really all that the percent change enables us to do, but it enables us to do it faster. And so we're not eyeballing anymore. We actually have numbers to look at. So like I said, accounts receivable is about 25%. I kind of said, thumb in the wind kind of guess, and I was pretty right. It's 24%. So that's a significant. Now, the question is like, well, whoa, and then you go to inventories, like, whoa, we didn't even notice that. That's 50%. Other current assets, 43%. In my initial eyeball, I didn't even really pay attention to inventories. I didn't pay attention to other current assets. I really was just focused and kind of obsessed with accounts receivable, right? So, this percent change, using this percent change kind of brings into clarity very quickly the changes that are happening, in this case between years. And it would be nice to have like, say, 2014, so we could compare percent change from 15 to 16 as well as 14 to 15 to see if there's a trend happening, right? We don't have that because I didn't have the 14 data. So let's talk about this for a second. Which one are we more concerned about, the 24% change in accounts receivable or the 50% change in inventories? I mean, 50%, that's a lot, right? That's twice as much as the change in accounts receivable, but we were just kind of, mulling over the accounts receivable and didn't even mention inventories. So what are your thoughts there?
Aren't inventories considered short-term assets? So they go out within a year. So you're more, or spent up within the year. So you're more concerned about your accounts receivable.
So all of these meet that qualification. Like everything here is a short-term current asset, right? Inventories, like accounts receivable, are a flow. So they're both constantly being used. The inventory is constantly being used, and then we're buying new inventory. So it's kind of a continuous process. So we go back to the tub metaphor that I used, right? The bathtub with the water coming in and the water going out, and you have kind of the aggregate level depending on whether the drain is going faster than the spigot putting it in.
You're definitely going to use them, or you're definitely going to get your value out of it. With accounts receivable, you're not positive if you're receiving it.
Well, that's a fair point, right? So that's actually accurate. Accounts receivable, you have an allowance put in there when and I didn't write it in here, but if you went to the notes, it would tell you how much of the accounts receivable they actually think might not get paid. Let's see. So Cole said, does it look like they expanded their patient services? Well, one way to find that out real quick is to go to the income statement. So we could do that, if you want to kind of mull it over. So we can look and see NPSR went from 316 to 355. So that's a pretty significant increase, right? We'll do our percent change here in a minute. But that's a pretty, so the answer there, Cole, is yeah, they did actually increase. And so at least some of the accounts receivable increase would be justified given the fact that they had an increase in billing, right? But I really want you to focus on and tell me about why we're not getting too wound up about the inventories as opposed to we were, when we did our initial kind of eyeball. Even though inventories jumped by 50%, even though other current assets jumped by 43%, we were kind of focused on that accounts receivable change. Percent change compares new to old, blah, 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 small number. Yeah. So Caitlin, I think you're right. So Caitlin's got it in the chat. Yes, it's a 50% change, but it's a 50% change on a relatively small number. I mean, now, $2 million to me is a lot of money. But if you're a organization that is billing out or collecting $355 million, then a $1 million change from 2 million to 3 million is probably not something to get. It's something that you would notice and should notice as a man, for sure as a manager, probably as a board member, you might be like, hey, what's happening with that? But you're not going to be like, whoa, hey, stop the presses. We need to have a conversation, in detail about what's going on, right? And yes, Caitlin, your point about more volume. Yes, if you do more volume, you're going to need more inventory. That's just kind of a thing that goes along together. So those are good observations. So my point here is a 50% increase on a relatively small number is not going to wind you up as much as even say a 10% increase on a very big number, right? So it's yes, the percent change is important. It should draw your eye, but you want to be focused on things that are material right? We use that word in accounting a lot to mean things that really matter, are material. This matters. I mean, $1 million is not nothing, but it is as a percentage of the overall budget, which is what we'll, or the overall number of assets, which is what we'll do here in a second. It's a relatively small amount. Okay, so the percent change column that you build here should bring, the goal is for it to draw your eye to big changes. So as an analyst, you care a lot about change, right? You want to see what is happening. And so this tool, this calculating percent change, gives you a very quick insight or ability to kind of very quickly spot places where you should be applying your analytical effort, right? You're not going to apply your analytical effort to a 1.2% change. That's basically zero, right? But a 50% change might be significant, and it's going to be significant if the numbers involved are significant. I'm looking for another, like, if there's another big jump somewhere. Well, that one's, that one we talked about a minute ago. Come back to that. So quickly, if you scroll down, what else hops out at you? Well, a 35% decrease in money held by the trustees. That might be concerning. That's, we need to make sure that, because this is a contractual arrangement, we need to make sure we're meeting that contractual arrangement. Because if you don't, if this is a part of the bond contract, and the bond contract says you have to have a certain amount of cash on hand ready to pay us, and if you don't, you're in technical default, then they can take you to court and force you into bankruptcy. So that's an important point, and that would probably draw your eye, just not so much because of the amount, but because of its legal nature. Right. So then we can scroll down into liabilities. So what jumps out here? Well, there's a couple of fairly large numbers, and you might want to drill into them. This one is the big one, right? We could look that up in the notes. I'm not going to do it today. And you can scroll down, and then, oh, hey, change in unrestricted. This is pretty significant. All right, change in essentially what's retained earnings. And so their equity accounts have gone down, whereas their liabilities have gone up. So that's as a percentage, right? So that's concerning, that liabilities have gone up and assets, and equity has gone down. So that's a fundamental change in the way they are financing their organization. Okay, so percent change, fairly straightforward. Nothing, that you do that probably a fair amount, for various things just in your normal life, because it's a useful tool. It's a quick and dirty tool for noticing changes, right? And we care a lot about changes as analysts. Now I'm going to do what's called the common size, and this is useful again for doing comparisons across time, but also across organizations. And I don't have in here another organization to compare, but we'll do a change across time. So when we do common size, what we're going to do is we're going to express each of these numbers as a percentage. So as a percentage of the total. So we're going to express cash and cash equivalents as a percentage. So I'm going to type equals. I'm going to choose cash and cash equivalents divided by total assets. So I want to express cash and cash equivalents as a percentage of total assets. And I'm going to do C4 divided by C22. But I'm going to do everything, and that's what makes this common size. I'm going to express all of these numbers as a percent of total assets. right? So I'm going to express cash as a percent of the 323 million in total assets. I'm going to express short-term investments as a percent of the 323 million in total assets, and so on down the line, right? I'm going to express the 81 million in property, plant, and equipment as a percentage of total assets. So when I do that, to make this quick, I could type this down, right? If I do that and then I just copy it down, though, what happens is I start getting all these weird numbers. Why? Because it took short-term investments and then it divided it by the cell below total assets. So I need to do a change to my formula, and what I want to do is lock the reference to total assets. The way I do that is on a Windows machine, you could just hit F4 and it puts a $ before the column reference and a $ before the row reference. I'm not sure what you can do with a with a Mac machine, but you can just type the $ manually, right? In before the C and in before the 22, and that will work. But the shortcut, if you're on a Windows machine, is just hit F4, and it'll automatically insert the $. And now I can copy that down, and you can see it moved the reference for the numerator down, but it kept the denominator the same, right? And so it locked the denominator while allowing the numerator to change as I copy the reference down. And then I'm going to put it in percent format. So I'm going to go back up here to the number. I'm going to choose percent, and then I'm going to choose to have it be 1 decimal. So there. So now I can. So if you're all with me, now I can just copy that down, and then I can kind of copy that formula down. And actually, before we do that, I'll save time by doing the 2015 column at the same time. But so now we know that cash and cash equivalents is roughly 12% of the total assets. So 12% of CMC's assets are cash. 8% are in short-term investments. 14% of their assets are in accounts receivable, and so on, right? So now we can take that same formula, well, similar formula, and do the calculation for 2015. So with 2015, I want to take the 2015 cash number and divide it by the 2015 total assets. And then I want to lock the reference to the 2015 total assets number. And so we have 11.7%. I'm going to make it a percentage, give it 1 decimal, copy that down. And so now we know, now we're able to compare across years how the percentages line up. And so we can kind of see, all right, so now going back to that accounts receivable discussion, well, in 2015, accounts receivable was 12.5% of total assets. Now it's 14.8%. So whereas before when we saw, whoa, it's a 24% increase, well, how much has that changed in terms of the overall picture? Well, 12.5 to 14.8. Well, that's something, but it's not, maybe not as radical of a change as we had before. So what each of these allow us to do is frame our reference, right? So the percent change helps draw our eye to particular lines, right, very quickly. The common size then kind of maybe gives us some sense of how important or material those changes are. So now I'm going to copy that down. And I can go into that second section, the liabilities and net assets, and I'm going to leave it with a reference to total assets because total assets has to equal total liabilities and net assets, right? This number, the total liabilities and net assets, has to equal the total assets. So you can see when I do the, this divided by this, I get 100%. Down here, I get 100%. Everything has to ultimately add up to 100%. So where are the big changes? Well, liabilities were 65% of their financing. Now they're 75%. Equity was 34%. It's dropped to 24%. That would be important, right? That's kind of important to think about because that's how the organization is financed. All right, so these tools, right, give you an ability to kind of see what's going on with the organization. And so what you want is for it to draw your eye to particular places so that you can start to tell a story about what's happening in the organization, or maybe start to ask questions. Like if you were on the board, you'd want, or if you were a potential investor, you would want to know what was it particularly that happened here in this line, right? The accrued pensions seems to be the big change that happened that year. Okay, so we're going to leave the, and so I gave you, on the workbook I sent you, I gave you kind of the calculated version for each of these as well. So, going through, you can look at it. If you don't get it now, while we're working on it, you do have the answer. So now I'm going to jump to the income statement. We're going to do the same thing. In fact, why don't you go ahead and do that right now? So first calculate the percent change, and then I'll talk to you about common size. So take a second, try to calculate the percent change. Remember, it's new minus old divided by old. And start thinking about, once you get that, start thinking about what stands out to you as a result of these, of your percent change calculations, because we're going to use that, right? This is not just this is an exercise because this is a class, but this would not be just an exercise if you were a real analyst. You would be you're going to use that percent change as a quick way to identify, hey, where do I need to put my analytical effort? All right, so in the interest of time, I'm going to keep going. So I take new minus old divided by old, and don't forget to put that those parentheses in, otherwise you're going to get some wacky numbers, right? So 10.9%, I'm going to convert it to percentages, give it 1 decimal, and then I can start copying this down. So real quick, what pops out? Well, 11% increase, that's pretty good. That's exciting. 11% increase in revenues is an exciting number. That's really great. So they had a good year. A 5% decrease in allowance for doubtful accounts or provision for doubtful accounts is a good news story, because that means they think they're going to collect more money than they did in prior years, even with an increase in billing. Now, what was happening here? Well, Medicaid expansion happened, right, in the 14-15 period with the ACA, and so those effects were happening. And Manchester, you're going to see a lot of Medicaid. And CMC's mission is in part to take care of poor people. Disproportionate funding. So here's a 365% change. That's a big deal. But again, is it material, right? Well, yeah. 10 million increase is material. That's important. And you would have this is a policy change. And so you would know something about that, so that you'd care about that. So overall revenues going up 14% is really great. A chunk of that is coming from this change, which is not anything that CMC did itself, but this change, the 12%, right, is what they did do themselves. So that's important to kind of be able to disaggregate and look at, right? So total revenues up by 14%. That's good. They had an increase in salaries, an increase in supplies, which we've kind of talked about. Inventories going up, that makes sense, right? Depreciation, well, that depends. It's kind of hard to say. Their interest went down, so that's good. So you would expect to see some increase, particularly in these areas, the salaries and the supplies. You would expect to see go up because they were doing more work. So that makes sense, right? That's consistent. The New Hampshire Medicaid enhancement tax is the way that the disproportionate share funding, or DSH funding, is funded in the state of New Hampshire. So the hospitals get money from the state, and then they get taxed by the state. And so as it turns out, they're a lot better off than they were, because they were only getting $2 million and they were paying 14. Now they paid 15, but they only received 11. So on net, they're actually net payers, right? So that's interesting numbers. So their expenses are up 10%, their revenues are up 14%. So that's a good news story, right? And wow, their income from operations is really nice improvement. Right, so that's exciting to look at. So you'd want to spend some time thinking about that and where did that come from, right? And scrolling down some more, investment income. So now we're in the non-operating area, right, which is less in the control of management. And so investment income went down. Okay, this is where we've talked about in the past, where the market gives and the market takes, and it really has very little to do with what your management is doing. And so you don't really want to reward management all that much for non-operating gains and losses. And so they had 124% decrease in non-operating gains and losses. Ought to draw your eye. You might have a conversation about it at the board level, but are you going to punish the CEO for that? Probably not. And so they had a 51% increase in net income, right, over year, which is pretty impressive. Most of it coming from the change in operations. All right, now we're going to do the common size for the income statement. And the denominator that we use with the income statement, whereas we used total assets for the balance sheet, this is important for you to remember. So when you do the common size for the income statement, you're going to use total revenues. Okay. And so to calculate that, then you're just going to take each of the entries and divide them by total revenues. And again, I'm going to lock the reference to total revenues. And so NPSR, net of contractual allowances, is 99%, right? And I'm going to turn it into a percent, 99.5% of total revenues. I'm going to do the same thing for 2015. I'm going to take the 2015 NPSR, divide it by the total revenues. I'm going to lock the reference to total revenues, and I'm going to set it as a percent, right? And then I'm going to just start copying down. All right. So, again, we're looking for, when we're doing our analysis, we're looking for big changes. So 11%, those are significant. 13% increase in other revenue. is significant. The other revenue would be explained in the notes in the financial statements. So if you had access to the financial statements, you'd be able to, you'd see some discussion of what was rolling in there, and then talk about the gift shop and the cafeteria and other things. Right. And so you'd scroll down here, but also at the same time, you want to see as a percent, these, even though we've had an 11% increase in patient service revenue, and so you would expect to see differences here. What this allows you to look at is the composition of the statement. So, and allows you to kind of eyeball where are big changes happening. These changes are not super significant, but there is some drift here. And so, we start going down, probably more interested really in expense control. And so salaries and wages, we're actually decreased our salary costs. That's good to see, relative to our income. Our expenses went down. And here we have income from operations expressed as a percent of total revenue, which is what ratio? What is income from operating income divided by total revenue? Operating margin, right? Okay. So anyway, so this automatically calculates operating margin. So you can see the operating margin rose from 7.8 to 11.7. So that's a good news story, right? That says operations are going pretty well. And then down here, you can see, how did these are non-operating relative as a percentage of total revenue is pretty small. So I'm not going to get wrapped around the axle around these numbers, because they're pretty insignificant. They're not all that material to the health of the organization. The organization did well, right? So an increase, this is a proxy for profit margin. It's close, right? It doesn't incorporate non-operating revenue. So we have a second, another quick way to look at and evaluate the income statement. So this is a technique. All right, so I've only got about 20 minutes left, so I want to look at ratios using CMC's data, and I have included in here, so I'm going to jump to the common ratios. And I've included in here, EHR stands for Exeter Health Resources. So this is the parent company for Exeter Hospital, Core Physicians, Rockingham VNA, and they've got a couple of other small corporate entities that are not particularly important for us. But what this would allow us to do is compare. It would give us a comparison for CMC. Now, is Exeter the best peer to compare CMC to? Probably not, because Exeter is about 70% the size of CMC. CMC is quite a bit bigger. The reason I'm doing this is because I happen to have Exeter's data, so that's just a matter of convenience. But what it does do is it gives us an opportunity to, it gives us something. It's not unreasonable. It's not like I'm comparing CMC to, a nursing home or something like that. So it does give us a reasonable thing to compare to. We've talked through all of these ratios, and I'll just calculate a couple of them and I'll leave the rest for you to do. So let's, so we talked about return on assets and return on equity. So we can, so return on assets, return on assets, right, is one of our basic measures that we use to evaluate profitability, right? So these are all organized in different categories. So to get return on assets, I'll just do a couple of these. return on assets is going to be net income divided by total assets. So I'm going to go to get net income, I go to the income statement. So I'm typing equals, and then I click on the income statement, and I go to, I'm going to do the 2016 data. So I take the net income, and then I need to divide it by total assets. So I go then to the balance sheet, and I grab total assets. And you can see it's got this funky addressing that says, go to the CMC income statement sheet and grab C31, which refers to the net income, and then go to the balance sheet and grab C22, which refers to total assets. And so we've got CMC had a 13.4% return on assets. How about its return on equity? Because we talked about how return on equity is actually more important than return on assets, because return on equity tells you what's the actual return to the investors as opposed to a return on kind of the overall resources. So I'm going to look for, again, net income divided by, now I want just the equity. Well, the equity, total net assets is my equity, so 78 million. So look at that, 55% return on equity. That's pretty significant, especially considering when you look at both of these numbers with respect to Exeter, those are big changes. I'm going to skip operating margin. I'm going to do total margin because I want to fill in the references here below. Oh, that should be, no. I'm going to do total margin. So total margin, remember, is net income divided by total revenue. So I'm going to, again, go to grab net income divided by total revenue. So total revenue is the operating revenue plus the non-operating gains and losses. And so I get 11.5%. I'm going to do total asset turnover. I'm skipping operating margin. I've given you the answers here, right? So you can go and do that yourself. Just because for time's sake, I'm only going to do a few of these. Total asset turnover now is total revenue, right, divided by total assets. So remember, total revenue, when we say total revenue, we mean the operating revenue plus the non-operating gains and losses divided by the total assets, which we've got to go back to the balance sheet to get. And so I get 1.16. So total asset turnover, remember, bigger is better, right? So CMC appears to be doing better in terms of managing its assets than Exeter is. I'm going to skip fixed asset turnover. I'm going to jump down to, what else do I want? We could do days cash on hand. That is a liquidity measure, right? And so I want to grab cash plus marketable securities. So I'm going to go back here to cash, and marketable securities is another word for short-term investments, divided by, and what I care about here is expenses, right? So I want to do the cash expenses. So I'm going to take my total expenses, but I want cash expenses. So that means I want to eliminate depreciation. And then I need to divide this by 365. And I also need to have that all in parentheses. And so I get 75 days cash on hand. So they're not as good as Exeter in terms of cash on hand. I'm going to skip down to capital structure measure. So we have debt ratio. which we've done in the past, right? Debt ratio is total liabilities divided by total assets. So they have a debt ratio of 76%. Now we see some significant difference, right? The debt ratio for CMC is double the debt ratio, more than double the debt ratio that Exeter carries. So is this a concern to you? Well, the answer should be, if you're an analyst, the answer should be yes, right? Why? Well, because the higher your debt ratio, the more leverage you've taken on, right? You've got to pay the bankers, the debt holders expect to be paid regardless of how well you're doing in your operations. So CMC is taking on a lot more financial risk than Exeter is. Equity multiplier is kind of the inverse of the debt ratio. It asks, instead of saying what percent of liabilities is assets, what percent of assets is liabilities, it says, how many times is your assets larger than your total equity? Well, if you figure total equity plus total assets is, total equity plus total liabilities is equal to total assets, right? This is kind of like the mirror image of the debt ratio. So we're going to take total assets, go back here to total assets, divided by total equity, which is total net assets, and we get a equity multiplier of 4.14. So in this case, CMC has about 3 times as much assets to equity ratio, which reflects the fact that they carry more than twice as much debt as Exeter Health Resources does. So they are leveraging up a lot of this. This is a way to look at how much leverage do they have, right? So roughly 1/4 of their one way to look at this would be roughly 1/4 of their assets are funded by equity. Another way to look at that would be, well, 76% of their assets are funded by debt. Well, if 76% of their assets are funded by debt, 24% are funded by equity, which is roughly 1/4, right? These two things basically say the same thing. They just say them in slightly different ways. Why is that important? I'm going to skip these other two measures for a second and jump down here to the Dupont analysis, which I talked about in the last class, which gets into, right, which takes ROE, which is the number we really, really care about as investors. At the end of the day, the bottom line, right, is we care about ROE as investors. We've put money into an investment. We want some return back on that money, and that's what ROE is. Now, just looking at ROE, CMC seems like the better investment, right? But when we look down here, we say, oh, hey, you know what? Exeter's actually got a better total margin. They're doing a little less well on asset turnover. So the 3 components of ROE from Dupont analysis, right, are total margin, which is expense management, right? That's how how do we interpret the Dupont analysis? Well, total margin tells us expense management. How well is management doing in terms of managing expenses? And it looks like Exeter is actually doing a little better than CMC is. How is it doing in terms of total asset turnover? Well, this is utilization of resources, and so CMC is doing a little better than Exeter on utilization of resources. And then this is financial leverage, right? So these first two are operational measures. in the sense of total margin is the how well is the business generating revenue. This is how well is the business generating revenue with respect to the resources that it has. And this is pure financial leverage. Now, here's an interesting thing. What if we were to deleverage CMC? Meaning, what if we were to imagine that CMC had the same capital structure, meaning the same financing as Exeter does? Instead of being so loaded up on debt, what if we said, okay, how would the return on equity look if we adjusted CMC's leverage, its financial leverage, to look like Exeter's? So a quick way we can do this, because this is a formula here, the ROE is a formula based on these three components, right? What I can do is I can go in here and plug in, I can replace CMC's actual equity multiplier with Exeter's actual equity multiplier, and essentially in the model refinance CMC. Now, you can't actually just do this in the real world, right? There's real world consequences to this. But what I'm trying to say is, right now, CMC looks like it's doing a lot better than Exeter in terms of its ROE, right? So if you're just looking at these two numbers, as investors, and you're saying, which would you rather be invested in? Would you rather get 22% or would you rather get 55% return? Well, I'd much rather get 55% return, right? So it's more than twice as much. That said, do you have an appetite for the amount of risk that CMC represents? Well, let's see what that, and when you adjust for risk, what does that look like? Oh, look at that. When you take away the financial leverage, right, the return on equity no longer looks as good. So what's happening? Well, CMC is taking on has a lot of debt. It's taken on a lot of financial leverage. That, as a result of that, it makes their ROE look better than maybe you could say it really is. And the way I'm saying that is, adjusted for risk, CMC's ROE is actually not as good as Exeter's. So you want to, as an analyst, you don't want to just look at one number. This is kind of the big, so here's the big reveal, the big takeaway from this chapter is you never look at just one number, right? Because one number can deceive you. So, this is, at the end of the day, the most important number, but that most important number is the result of many other moving pieces behind it. And one of the most important moving pieces when we're talking about return on equity is financial leverage. And so one of the ways you could look at this is, and you'll hear this discussed, is the quality of earnings, right? The quality of return. And in this case, yes, they have a very high return on equity, but the quality of that return is low, relatively speaking, because they have so much leverage. If things go bad for CMC, right, if their revenues go down for whatever reason, maybe there's a global pandemic, say, they're still going to have to pay their interest payments, right, because they're 76% financed by debt. So that makes them much riskier. And in finance too, we'll actually do some calculations on to express that financial leverage. But just in using ratios, we can kind of decompose the earnings, right? And that's why I think the Dupont analysis is kind of cool, because it gives you three different lenses, well, four really different lenses to look at the organization, but three different lenses to kind of analyze the quality of the earnings, right, of the organization. And in this case, right, we're able to look at expense control, right, or expense management, asset utilization, and then financial leverage. And the big kind of shocker here is, wow, there's a lot of financial leverage going on there, Now, Exeter, I will tell you kind of, you know, to balance this out, Exeter is a more conservative organization than other organizations, but not crazy conservative. Normal is like around 40 to 45% debt ratio, so they're a little low, right? So their equity multiplier is a little lower than normal, but it's not crazy lower. That's a big number. That's kind of an unhealthy number, right? All right. So you've got the answers. You can look at that. All the numbers have been worked out. You can look at them there. Let me see. Where did my... So that's chapter 17. So we've done 8 and 17. So the final exam is going to be focused on 8 and 17. Obviously, with 17, you have to kind of refresh on 3 and 4, because the relevant information is, you know, we're drawing on the financial stuff that we did back at the beginning of the course. So you're going to need to be able to draw on that knowledge again for the final. For the final, I'm going to ask you to do, I will tell you up front, I'm going to ask you to do, you know, common-sized balance sheet, common-sized income statement, express something in terms of percentages, but I'm not going to just stop there, because that's just copy and paste. I'm going to ask you to do some analysis. I'm going to ask you to do some of the discussion that we did today, saying, all right, identify where some of the big changes are, right? Help, you know, as an analyst, what are you concerned about here? Why are you concerned about that? And I'm going to ask you to, you know, calculate those ratios, but I'm not going to just ask you to calculate the ratios, because that's pretty easy. I'm going to ask you to interpret the ratios, right? And tell me something about the quality of earnings, for example, right? You know, tell me, okay, so this organization has an ROE of whatever. Is that a good number or a bad number? And the book has lots of examples of working through that, right? So the Dupont analysis is a nice tool for thinking through that kind of stuff. All right, so that is it for this course. So you have now successfully completed Finance 1. Hopefully I will see you in Finance 2. Because it's an important course, and you'll need it for planning, and you'll need it for strategy or capstone. Hopefully I'll see you in, but it's not mandatory. So hopefully I'll see you in Finance 2. So any questions in the last couple of minutes? All right, so final exam is the 16th, right, which is Wednesday. So you should have signed up into your teams at this point. I haven't looked lately. If you are not in a team, I'm going to drop you into a team probably today. So you should be in teams of 4. And you'll be doing this. So I'll be sending out a spreadsheet, right, with a series of there'll be an Excel workbook with a series of sheets. Each sheet will have 1 or more problems to work out. You know, it'll have some financial statements for you to muck around with, and so you'll turn in you'll take that workbook and you will do the work in the workbook, and then you will turn in the workbook as your team's submission for the final exam. If you want to do stuff on paper instead of doing it in Excel, that's fine. What you would then do is you would take a picture of your work and then insert it onto the appropriate sheet. So if I give you a problem to calculate some ratios, for example, and you don't want to use Excel for whatever reason, you can do it on paper, right? And then take a picture and then insert that picture into the Excel worksheet for that problem. All right, and I will accept that. I think you're more likely to make a mistake, but if you're not comfortable, if your group is not comfortable with Excel, that's acceptable. All right. Then that concludes the course. So I will hang on here if anybody has any last minute questions, but otherwise you are free to go, and I will be in touch on Wednesday.